In the complex and often intimidating world of investing, many people feel deeply overwhelmed, constantly searching high and low for the next big stock tip or the perfect market timing strategy that promises quick riches, yet rarely delivers. But what if there was a simpler, more reliable, and far more effective path to building substantial wealth over time, one championed by a true pioneer in the investment industry? Imagine a strategy backed by decades of proven success. Today, we dive deep into the Little Book of Common Sense Investing by the legendary John C. Bogle, the founder of Vanguard Group, whose innovative ideas transformed how millions approach their financial futures. John C. Bogle, who sadly passed away in 2019, revolutionized the entire investing landscape by popularizing low-cost index funds, launching the very first one available to individual investors back in 1976 with the Vanguard 500 Index Investor Fund. This influential book, first published in 2007 and updated in 2017, powerfully argues that passive investing through low-cost index funds is the only reliable way to guarantee your fair share of stock market returns without the pitfalls of speculation. Our goal in this video is to thoroughly break down its core principles, inspiring you to embrace this common-sense approach to investing. And we encourage you to subscribe to Book Bites Guru right now for more life-changing book insights on building wealth. Let's kick things off with Bogle's first crucial lesson: the inherent and often fatal problem with active management strategies that dominate the industry. Bogle famously labeled stock picking and market timing as a loser's game, and the overwhelming historical data completely supports this harsh reality of consistent underperformance. For example, from 1987 to 2006, only a mere 21% of actively managed large-cap funds were able to beat the S&P 500 after accounting for their hefty fees, showing how rare success truly is. When you extend that to a full 15-year period, the number drops even further to just 6% succeeding, which starkly highlights the extreme difficulty of consistently outperforming the broader market over the long haul. The primary reason behind this failure is high costs. Active funds typically carry expense ratios around 1.3%, in sharp contrast to just 0.06% for Vanguard's S&P 500 Index Fund, creating a massive drag on returns. These seemingly small percentage differences, combined with additional turnover costs ranging from 0.5% to 1%, compound over time and significantly erode investor returns, turning potential gains into substantial losses. Bogle's famous and memorable analogy perfectly captures this truth. Don't look for the needle in the haystack, buy the haystack. This simple wisdom underscores owning the whole market instead of chasing elusive winners. This naturally leads us directly to the elegant and straightforward solution that Bogle proposed: the revolutionary power of index funds as the superior investment vehicle. Index funds offer simple yet powerful alternatives by owning the entire market, thereby capturing its full return while deducting only minimal costs, making them ideal for everyday investors. By choosing to invest in an index fund, you are effectively betting on the long-term growth and resilience of the entire economy, rather than gambling on just a few select stocks that may or may not perform. Take the S&P 500, for instance, which has delivered approximately 10% average annual returns from 1926 to 2023, standing as a powerful testament to the enduring effectiveness of this broad market strategy. Bogle's groundbreaking first index fund dramatically grew from just $11 million in assets in 1976 to over $100 billion by 1997, providing undeniable proof of its immense and transformative success. This proven approach empowers investors to fully participate in America's long-term economic growth, which has historically been projected at 6 to 7% real GDP growth, fueling prosperity across generations. Now, let's delve even deeper into how those insidious costs can silently sabotage your financial future through the relentless force of compounding. As Bogle revealed in detail, a seemingly modest 1% fee can drastically reduce your ending wealth by a full 28% over a 40-year investment horizon, illustrating the hidden devastation. If you increase that fee to 2%, nearly half of your potential wealth, precisely 48%, simply vanishes into thin air over the same period, underscoring the urgency of cost control. At an even higher 3% fee level, a staggering 63% of your potential returns are lost forever to fees, leaving investors with far less than they deserve. To put this in perspective, consider $10,000 invested at a 7% gross return for 50 years. With 0% fees, it balloons to an impressive $3.5 million. However, introduce just a 2% fee into the equation, and that same investment sadly dwindles down to only $1.3 million, revealing the profound impact of fees on long-term growth. Active funds rack up total costs averaging 2.27% annually, while index funds keep it impressively low at just 0.1%, a difference that adds up to millions over decades. Truly understanding this tyranny of compounding costs is absolutely crucial for anyone serious about protecting and maximizing their long-term wealth accumulation. But shining on the other side, beyond costs, there's a powerful and majestic force working tirelessly in your favor, the extraordinary majesty of compounding returns. This is precisely where your money begins to truly work for you, generating impressive returns not just on your initial investment, but also on all the accumulated interest and dividends over time. Remarkably, reinvested dividends alone have driven approximately 42% of the S&P 500's total returns since 1926, highlighting their critical role in wealth building. The absolute key to unlocking this power is to start investing early. Picture investing just $1,000 at age 25 with a steady 7% annual return. By the time you reach age 65, that modest initial $1,000 could have grown into a substantial $149,000, all thanks to the magic of compounding over 40 years. In stark contrast, if you delay and wait until age 35 to make that same $1,000 investment, it only reaches $71,000 by age 65, demonstrating the high cost of procrastination. This vivid example illustrates the immense and unforgiving power of time in the compounding process, making every single year of early investing count tremendously. Equally vital to success is committing to stay invested through all market conditions, even the toughest downturns that test your resolve. History repeatedly shows that markets always recover in time. The S&P 500 endured devastating crashes like 1929, 1973 to 74, 2000 to 2002, and 2008, yet invariably bounced back stronger. This resilience brings us to Bogle's final and critical lesson: the essentials of smart asset allocation combined with the discipline of staying the course no matter what. Bogle recommended constructing a diversified portfolio, such as 75% in stocks and 25% in bonds for younger investors, then gradually adjusting the mix as you approach retirement. A practical guideline he endorsed is the age in bonds rule, which suggests slowly increasing your bond allocation to roughly match your age by the time of retirement for balanced risk. Crucially, you must rebalance your portfolio annually to maintain your targeted allocation, preventing drift due to market movements. Discipline proves paramount in practice. During the harrowing 2008 financial crash, while the S&P 500 plunged by 37%, bonds actually rose by 5%, providing essential stability. This real-world example powerfully demonstrates why maintaining a balanced portfolio is so vital to weathering even the fiercest market storms successfully. The rewards of such discipline are immense. The S&P 500 skyrocketed by 1,400% from 1982 to 2000, proving that staying the course through volatility delivers extraordinary long-term gains. In summary, Bogle's timeless and profound wisdom ultimately boils down to embracing common-sense principles, unwavering discipline, and patient long-term thinking in all your investing decisions. His seminal book lays out a clear, uncluttered roadmap to genuine financial success by prioritizing simplicity, ruthlessly minimizing costs, and focusing on enduring strategies. To access the full, detailed strategy and completely transform your investing approach for the better, we highly recommend that you buy the Little Book of Common Sense Investing today. You'll find the purchase link conveniently placed right there in the description below, making it easy to get started on your path to better investing. And please don't forget to hit that subscribe button for Book Bites Guru, where we deliver more essential book insights designed to help you build real wealth and ultimately achieve true financial freedom.